Hi, everyone, and welcome to the call. We'll be getting started in about 30 seconds. So we will see you just in a minute. While everyone's getting settled in, and it's so great to see so many familiar faces join us online, I do want to, welcome you. My name's Claire. I'm really proud to be a part of our team here at iBuyNew and to introduce you to the webinar. What you can see there on the screen is a prompt where you can use your chat function, whether you're on your phone, your laptop, iPad, whatever it is, you will have that chat function throughout the call to send through any questions that will only come through to us at iBuyNew. There's no silly questions. And whether it's in the call today or moving forward working with our partnerships manager, we can assure that your questions will be answered. So let's get into it. We're sure that a lot of you are on a lunch break, and we really appreciate you spending that lunch break with us. And what we're really excited for is the launch of what is essentially a series solely for you guys as our partners, which includes a market review where each quarter we're going to be going through what insights or what trends we can learn from the quarter that's just been, as well as the key opportunities for the next quarter moving forward, including property opportunities and key investment areas for your clients. And so we welcome you to the official kickoff for this series that we'll be doing every quarter. On that note, I'm really excited to introduce you to our webinar hosts, who are our CEO and partnerships manager, who are going to be taking you through each respective part of the session that I just mentioned. So to kick things off, I'm really excited to introduce you to our partnerships manager to talk about iBuyNew and to officially kick off the call. So I will hand it over to you, Rob Chambers.
Thanks, Claire, and welcome all. It's great that you could join us. It's great to see a lot of you online that I know and have been speaking to regularly. And for those that I haven't, welcome and thanks for joining. And hopefully this information will be of real value to you. So for those who aren't that familiar with iBuyNew, we're a off-the-plan property specialist, and we offer tailored advisory services to help investors grow their property portfolios. So our expertise lies in the insights that we provide, the in-depth analytics, and the fact that we carefully curate project selections to guide investors to making informed and good decisions. iBuyNew's been around for over 15 years. We've transacted over 3,000 property transactions, and we have over 300 Trustpilot reviews with an average 4.9 star rating. So who are we for? We're essentially for investors, and they might be first-time property investors, experienced property investors, investors that are looking to use their self-managed super fund to invest in property, or time-poor, high net worth individuals. We follow a very rigid client methodology at iBuyNew. We don't just present any project. We take the time to evaluate and get to know all of our clients, understand what their motivations are, understand what their financial capacity is, and also what their objectives are. Then we use independent data, including hotspotting and Orbis research, to back all of the recommendations that we make. And we hold the client's hand to transact on the property and also to communicate with them right up until settlement. So a little bit more about our selection framework. It's essentially broken down into 3 key areas. The first one, and probably the most important, is location. We look at the macro and micro location and proximity of the site to infrastructure and amenities, including what's planned moving forward. We look at the development itself, the quality of it, the design, the layout, the pricing, and how does that compare with other projects in the area. And we look at the developer itself. We take a deep look into their background, their track record of success, and whether or not we feel comfortable and confident that they're going to be able to ultimately deliver the project that they say they will. And so we outline that all in terms of the benefits to the client so that they feel confident and comfortable with each project that we recommend. So what does it mean to be a partner or to partner with iBuyNew? So the first benefit, and this is something that not all partners are interested in, but we're happy to provide referral fees to partners that introduce qualified clients to us. There's no operational burden on your business. We're essentially a trusted and independent property advisor that you can tap into. It's a value add to your clients because they're able to access a independent trusted property advisor to guide them through off the plan purchase. We also are working on a property partner portal that our partners will have access to, which gives you access to the properties that we've already evaluated. It's a way that you can expand your offering nationally. So we're a national business. We operate in the states of Victoria, New South Wales, Queensland, Western Australia, and we also operate out of Singapore. And the other big benefit to you is events such as this one here, webinars that are exclusively for partners, as well as educational content. So I'm just going to hand over to Dan Peterson now, our CEO, and Dan's going to take it from here.
Great, thanks, Rob. And we're welcome all to today's webinar. As Claire sort of highlighted right up front, this is the first of what we hope to be many, at least a solid cadence of quarterly updates, so that our partners that are referring clients to us feel really well informed, feel confident to be referring clients to us, but also be opportunistic when they see clients that have got the right fit and got the right sort of intentions, and they understand some of the recommendations we're running at a certain point in time, that they feel confident to at least make that initial introduction. So really today we're going to do a quick update around the market in terms of what we've been seeing from sort of Q3. We're going to take you through 4 or 5 different investment opportunities and recommendations that we're running at the moment. It's a selection of around about sort of 12 or 13 that we've got right now, but probably the 3 or 4, maybe even 5 I think we might have that we're going to take you through, which is really probably for the next couple of months that we'll be using and running with before they are sold out. And then we'll just close by just sharing a little bit about some recent success stories and some other opportunities ahead in terms of events that we'll be hosting. So yeah, I think we've talked a little bit about this quarterly update series. We probably don't need a recap on that again, but yeah, what you are going to find is we'll do a bit of a market review. We're going to talk about top investment opportunities and then look to the quarter ahead. So we'll be doing that on a regular basis every few months. I'm going to start with just a bit of a market update about what's going on. I'd suggest quite a bit of this is well known, but hopefully it kind of brings it together in one fairly coherent story. The market's still been really positive, and this is data we've got for July, the month of July, and you can see on the left-hand side of the chart here that the areas that have been performing the best are really Perth, Brisbane and Adelaide when you look at the last month and the full year from the last 12 months. So Perth at double-digit growth, and these are medium house prices as well. These are medium property prices, medium house prices as opposed to property prices or unit prices, which I'll cover unit prices in a minute. But you can see that Perth and Brisbane have been sort of the standouts. Adelaide not too far behind. Probably one thing to call out is that the regional areas have still performed really well, particularly in WA, South Australia and Queensland, those 3 states. In fact, they've slightly outperformed the capital cities when it comes to capital growth. The one other thing maybe worth mentioning is Melbourne, and I think that certainly some people on the call here are in Melbourne and probably interested in this market a bit more than others. But the Melbourne market, in our view, has bottomed out now. It's been very flat growth now for a number of years, last 3 or 4 years, very, very minor growth, if any. And what you see in the last month in July is basically flat, minus 0.1. But when you look at the 12-month period, it's running close to 3% growth, and that's about as good as we've seen really in the last 3 or 4 years. The last 4 months have all been, prior to the month of July, have all been, albeit very small, 0.1, 0.2%, have been positive growth. So we do think July is a pretty, it's not the greatest month to be in Melbourne. It's peak of winter. Volumes drop when it comes to sales and the way this data is calculated. But we're not surprised to see a 0.1 drop. It's basically saying the market hasn't moved in a month. But when you look at it over a 3 or 4 month period, Melbourne has definitely turned the corner. In terms of house and unit prices, you can see that over a long period of time, houses and units have pretty much tracked each other. But we saw from sort of 2016, 17 that houses started to accelerate in terms of values over apartments. And that's really been quite clear for the last sort of 8, 9 years. But that trend has started to change. In fact, it's changed quite a lot over the last 1 or 2 years, in particularly in some markets. When I just shift to this chart here on the right, which is the price growth for July for apartments or for units, you can see that the standouts again have been Perth, Brisbane, Adelaide for both the month of July and for the last 12 months. But each of those markets have outperformed. The average price growth or the median price growth in apartments has outperformed houses. It's not by massive percentages, but it is by sort of 1.5%. And in some parts of those capital cities, we're seeing sort of more prevalent sort of price growth of apartments over houses. So, for example, in inner parts of Brisbane, where apartment supply is in hot demand and super tight supply, we are seeing extremely strong price growth in some of those pockets. So these, of course, are all of each of those cities, but across the board, apartments are outperforming houses in Perth, Brisbane, and Adelaide. And we've seen that now for sort of the last 12, 18, maybe 24 months. Across the country, we've seen a 1% increase over the last quarter. That's that June quarter. So really quite strong growth, despite a few headwinds, and which I'll come back to. As I said, units slightly outperforming. Brisbane, Adelaide, Perth, sort of top of the market. And as I just touched on before, Melbourne and ACT are actually two markets where we think they're kind of showing early signs of recovery, particularly in parts where there's tight housing supply and good, strong demand. The other thing worth calling out is obviously Southeast Queensland and WA, the two markets that have probably seen really strong growth now for 2, 3, 4 years. And it actually is backed by fundamentals of population growth and infrastructure spending, that they are the two markets where we're seeing really strong population growth. Perth now has more than 3 million people, tipped over 3 million about 3 months ago. Brisbane's got record immigration numbers, running at about 110, 120,000 a year. So just tailing Sydney and Melbourne, which they were previously running more like 40 to 60,000 a year. So the population growth in these areas is driving the demand on housing, and all the infrastructure spend that's going on there is supplementing that to keep driving capital values north in those two locations. Just quickly on rental values, you can see on the chart on the left here, this is 2019 versus the latest median prices in terms of rental values across the various states. And you can see, since COVID, we've had extraordinary growth in rental values, and I think it's pretty well publicised what's driving that. There is a massive housing shortage. We've got extremely tight rental markets. Vacancy rates are running at sort of 1 to 2%. In some pockets, less than 1%. We've got a couple of recommendations, which we're going to come back to in a minute, where the vacancy rate is less than 1%. And for those that are not aware, the market equilibrium is 4%. So when vacancy rates sit around 4%, generally speaking, rental values will stay pretty flat. As soon as it goes above, when you see 5, 6, 7, 8% kind of vacancy rates, normally you see over a period of time, not immediately, but over a period of 12 to 24 months, you see rents come down. They actually start to go in a decline cycle for a little while. And when they drop below 4%, particularly when they're at 1 and 2%, you normally see rental values grow. And that's exactly what we've seen over the last 5 years. But probably, like every area, like even Victoria, where you've had poor capital growth, you've actually had really strong rental growth. for those reasons I just outlined. But the one that has really exploded is Perth. That WA market, the rental values there have grown enormously. We're talking sort of 50-70% growth, depending in that range, over a period of 4 or 5 years. So it's pretty much been running at double-digit growth now for 5 years. And frankly, we don't see that changing immediately. I think at some point that's got to temper, but it will continue most likely because of how tight the housing supply market is in Perth, and we'll come back to that a little bit later. Thing just to kind of like overlay here is what's happening with building approvals and new housing starts. Now that's kind of having a look at the supply side of the equation, and we've got data, of course, that drills down between each of the states, and it also takes you through what type of housing. But this is just sort of a bit of a macro picture. I think most people are well aware that to meet our housing, our current population growth, and to just keep pace with it, that the industry needs to be delivering about 220,000 homes a year. I mean, the government laid down this 1.1 million housing target over 5 years. The reality is the industry just doesn't have the capacity to meet it. You can see where we're running at the moment. This is that blue line. That's your 220 running in terms of monthly approvals. That's running at just over 19. It needs to be running at about 19,000 a month. We're currently running at 15,000, 16,000. This is the current month of June, and July. The number is just slightly above that at just over 16,000. But we are trailing by something per month by 3,000-4,000 a month in terms of new home starts, just to keep pace with housing demand. And we haven't really been since kind of 2020. We haven't really kind of hit those numbers. We were hitting those numbers 19,000-20,000 a month back in 14, 15, 16. But since then, the industry has really struggled. Now, when you look forward, can the industry actually run at 19,000 a month? It's very, very unlikely. It depends who you talk to in the industry, but like when will there be enough capacity in the industry to get back to that level? It's been there before, but when will it get back there? And most people say that it's really not going to happen until the Olympics are behind us. It's not just about the Olympics, but the infrastructure programs that are running in each of the states. I mean, Melbourne's obviously got nothing to do with the Olympics. There's no stadium upgrades and new stadiums and infrastructure going in to support the games, of course. But the infrastructure program in Melbourne is huge, and it's a near on $90 billion program, which is being funded over about a 7 or 8 year period. But a lot of that is happening now through to 2032, that early sort of 30 to 34 range. And then obviously in Southeast Queensland, they have got the infrastructure program running for the Olympics. And that's dragging so much building capacity out of what would go into residential housing into all this infrastructure spending. So the reality is the market, or the industry, should I say, won't be able to get to that 19,000 or 20,000 a month to be able to keep pace with housing supply. So in our view, there is this structural shortfall that will persist for some years, and it's likely to be close to 7 or 8 years before we get back to kind of getting to levels that would at least keep pace with demand. So hopefully that gives you a little bit of a feel for what's going on. Now, I just want to just briefly touch on interest rates and tariffs, because it's obviously pretty topical. I think we're going to learn from the RBA. I think the announcement's around 2 o'clock. We're going to learn this afternoon what their latest decision is on interest rates. Obviously, all the betting markets are indicating it'll be a 25 basis point cut. It's been priced in already pretty well to the market, and given where sort of inflation numbers are at 2.1, 2.2, it's very likely now. I think we do see a rate cut. Obviously, inflation is not the only measure, but it's one of the key measures they're looking at. Labour markets just softened a little. So we do think we will see a rate cut this afternoon. If it's not, it'll be the next meeting. The rates have been cut twice, of course, this calendar year, getting us down to 3.85. Probably by the end of the year, we expect to be in that close to 3.30 range, or maybe 3.2. So that's sort of the likely outcome. we'll wait and see. We'll obviously all know that this afternoon. The other thing that, in terms of just on interest rates, and I think this is fairly intuitive, but whenever we see rate cuts and we see the reverse on an upward cycle, but on a downward cycle, straight away it creates greater borrowing capacity, greater affordability for people, and it just shifts confidence. People's confidence sentiment starts to improve, and whether it's first-time buyers or investors, they're probably the two segments of the market that get really active. And we have definitely seen that on the back of the first two rate cuts. I personally think, to get back to levels in terms of just confidence and momentum, which will drive capital growth in itself, we're still a little way off. I think we're probably 12 months away from that, but every rate cut definitely sends the market in the right direction. And then in terms of tariffs, look, I think we can get ourselves a bit sort of tied up in all this, but Australia is not directly, impacted by all these tariffs, with the exception of a couple of industries. But we are definitely indirectly impacted. And one of the things we've started to see emerge, and we think will continue, is that there is definitely concern and risk around the volatility of equity markets, and probably the pricing of equity markets at the moment, particularly in the US, starting to look pretty overvalued, or at least pretty toppy now. That there are a lot of investors we're starting to talk to, and I'm presuming you guys are having similar conversations, where they are now trying to look at de-risking their equity position and trying to find less volatile, safer investments, and property is prime for that. And we're starting to see that in a lot of the conversations we have with people, whether they're investing in their own name, through a trust or company, or in the self-managed super fund. That's a really common theme that we're seeing. So just to summarise, certainly from a supply perspective, don't expect any shift in terms of that tightness around housing supply, and that's going to keep pricing very firm, both in terms of rental values and in capital values. The second thing is that as I said, the rental market is already been growing in most locations between 5 and 10%, up to about 13-14%. And we don't see that changing, because supply is going to be incredibly tight still for the next couple of years, at least, if not longer. There is definitely a break point, an economic break point, where you can't keep increasing rents at 5 to 10% and outpacing wage growth and adding to cost of living. There is definitely a break point. How that gets determined is really by the market, and people that are buying in at more affordable housing levels are probably the ones that are going to do the best in terms of both capital growth and rental affordability, and rental price growth and yield as a result of that, in our opinion. And as I said, interest rates are only going to sort of boost markets as they get cut, most likely get cut over the course of the next 12 months. So hopefully that just gives you a little bit of a feel for sort of what's been going on in the market over the last quarter, and sort of our view of the forward view just for the next 12 months ahead. I'm now going to step through, I think, 4 or 5 different investment recommendations that we're running at the moment. I'm going to keep it reasonably top level, but I'll probably spend about maybe a few minutes on each, and then very happy to take questions at the end on some of these. And obviously Rob's here to give you the full detail of any of those that could be of interest to you or your clients. So I'm going to start with one in Melbourne. It's actually a townhouse development. It's in Canley. If anyone knows Canley, it's sort of on the northwest side of Melbourne. It's about 20 kilometres just outside of CBD. So it's in that inner ring, and it's in a great location within Canley. It's close to the airport, nearby the station. Great walk score. This particular development's relatively small. It's 18 townhouses. They're 3-bed, 2-bath, 2-car, starting at, in fact, all the pricing's running at $725. So we think it represents really good value at the moment. When you look at all the benchmarking on new properties, brand new properties in that area, they tend to sit in the sort of 700 to 800 range, even the low 800s. But at $725, it's definitely really well priced. It's a single part contract, so really good for both. Also good for self-managed super fund investors. The current rent is $650. There's a rental guarantee. The $650 is giving you a bit over 4. It's giving you a 4.5 4.8, I think it might be, rental yield. There is a guarantee at 4% for 2 years on this development. And we think we'll see good price growth in this particular pocket of Melbourne over the course of the next 12 months. We should expect to see, we think, sort of 7% growth. Now, of course, this townhouse is not completing until the end of 2026. So for those that are getting in now, with a 10% deposit, they will do well between now and settlement, and then hopefully, some really good growth, holding that asset on a long-term basis as Melbourne starts to recover. And certainly one of the things about Melbourne is that it does look even now, despite a few headwinds, looks really undervalued. And I think roll forward the clock another 6-12 months when this gets completed at the end of next year, it'll look even more undervalued relative to the rest of the market, as in the rest of Australia, particularly places like Brisbane, Perth, Adelaide. I think Melbourne will eventually rebound. It's got the fundamentals are very good. On this particular, there's a couple of renders here of the development. Probably the one on the top right probably gives you a pretty good feel of the architectural design of this. It's a good development. It's by a group called Resimax. If anyone's familiar with Resimax, they're one of the larger private developers in Victoria, and we've had a good long-standing relationship with them, and we know the product they deliver. It's really good, very consistent. They deliver on time. So from a brand and reputation perspective, it's a development that we're very comfortable with. There's really 5 reasons we're recommending this at the moment. Firstly, Melbourne's population is still the largest out of any of the cities in the country, and it's sort of running at 120, 130,000 a year. We don't see that changing. I think I actually have a bit of a personal view that come post the Olympics, I think Brisbane's already done really well. I think there'll start to be people, international migrants, thinking about do they migrate to Melbourne or Sydney, start to put Brisbane into that sort of that shortlist and that equation. I think Brisbane will probably start to pick up some of the population growth that Melbourne or Sydney would have otherwise been the beneficiary of. But yeah, having said that, Melbourne's population growth is still really, really strong, and that's just going to keep putting pressure on housing demand. The infrastructure spending, as I touched on a little bit before, there's still $93 billion program being run in Victoria, mainly Melbourne. So a lot of that infrastructure spending, we know, will ultimately drive. It'll improve a lot of these areas, particularly that inner ring and that secondary ring, the A ring, B ring, where a lot of that infrastructure investment's going, particularly in the west and northwest. That's all those areas will benefit really well. Canberra is absolutely no exception to that. It's in pretty close proximity to the major universities, and we've got obviously worldwide. We've got 6 of the top 50 universities in the world. So people from Northern Asia, Southeast Asia, when they're considering sending their children to Australia potentially to study, Melbourne is the number 1 location they think about, and Canberra will do well from that perspective. Certainly, this cycle, the cycle at the moment, Melbourne is definitely at the bottom of that cycle, and so if people are investing now on a medium to long-term basis, and that's certainly no less than 5 to 10 years, we talk medium to long-term, they will do well. The Melbourne market will recover. The fundamentals are so strong, and off the current baseline that it's at the moment, it will start to catch up to some of the other capital cities like Brisbane, Perth, Adelaide, etc. And the underlying economy, despite a little bit of doom and gloom at times post-COVID, and when we think about some of the state government decisions that have been made, I think some of us get a little down at times. But the bottom line is the economy is still really strong. It's actually thriving, and I think as some of the legacy issues of COVID and lockdowns kind of dissipate, the Victorian economy is fundamentally very strong. So for all those reasons, we see this being a really sound investment. Now, just switch gears a little bit and talk about Perth. There's one development in Perth that we absolutely love at the moment. It's in a little suburb called Como. It's a genuine blue chip suburb. So if you think about, I don't know, if people are on the line in Melbourne, those at least that are in Melbourne, think suburbs like sort of South Yarra, those inner suburbs. It's only a few kilometres from, or 6 kilometres from Perth CBD. It's a 5-minute drive into the Perth CBD across the Swan River. It's in super close proximity to Curtin University, which is one of the top couple of universities. It's within 10 kilometres of 3 major universities in Perth, and it's currently got as a vacancy rate in the suburb of Como, it's 0.4%. It's about as low as you ever see in terms of vacancy rates in any suburb in the country. So Como is where this project is. Now, it's a relatively small development as well. We are the exclusive selling group on this project. There's 18 apartments. There's about 1/3 of it's now sold. We've got 2/3 are left, and they're 2 and 3 bedroom apartments. They start at 840,000. In Perth, that is extremely well priced, and it'll complete at the end of next year, a little bit like the Canley townhouse I just spoke before about. This will complete at the end of next year. We're seeing yields around that 5% mark based on current rental appraisals, and the forecast growth. We're cautious not to talk about double-digit growth ever, even though Perth has been running at that very consistently. We'd see no reason why it will not continue to run in that 7 to 9% range, and with a fair bit of upside on that because of some of the things I spoke about with Perth before. Perth is attracting more population, more migration than ever before, and these parts of Perth are very tightly held, very hard to find properties like this. There actually is a 5% rental guarantee for 2 years on this, and there's a rebate that's available to buyers. The project's being developed by a group they're a private developer. They've been in business for over 30 years. They've done something like 40 projects across Australia, mainly in Perth, but they've also been developing on the East Coast. They've done a little bit in Melbourne, a little bit in Brisbane and the sunny coast. So they've ventured outside of WA, but their bread and butter is inner suburbs of Perth, and they've got in due course, if you want to have a look at their track record, they've got a very long list of projects they've delivered and developed over the course of the last 20, 30 years. Couple of renders you can see here on screen. Probably doesn't quite do it justice. This is a reasonably high-end development. You can see the bottom left there, the views from the rooftop. It's got a very small amount of amenity built into it. This is not one of these mega towers with millions and millions of dollars worth of amenity built into them, but it has got a nice amount of amenity for a relatively small development with 18 units in it, with beautiful views back, across the Swan River and back to the Perth CBD. The things we love about this, again, it's the fundamentals are really strong around Perth. This particular location is a thriving suburb. I talk about being a blue chip suburb, but it is, when you walk around Como, it's got everything going for it. Nice cafes, restaurants. It's right near the Swan River. You've got parkland, and particularly where this particular project is, it is literally opposite a lovely little park. But it's a thriving area that's forecast to generate really good capital growth. The Griffin Group is the developer that I just touched on before, and they've got projects all over Perth to have a look at if clients wanted to see that. And there is a 5% rental guarantee, despite us thinking that the yield's probably going to be a little bit above that. And certainly yields in the area, both Perth and in Como, are running more like at 6.5%. The guarantee just gives people absolute peace of mind that it's going to get good yield, and it guarantees that at least for the first couple of years. Now, the third one I want to touch on, I've just sort of skipped ahead to it, is actually also in WA. It's a little bit different, actually. It's in Kalgoorlie, regional town. Kalgoorlie is almost 600 kilometres, it says west of Perth, east of Perth. And so it's one of the largest regional towns in WA. I think it's the third largest regional town in WA. Anyone that knows anything about Kalgoorlie knows that it's a resource hub. It's a mining hub. It's basically all built around the Super Pit, which is one of the largest gold mines in the world. And that gold mine is creating an enormous amount of jobs at the moment. They're in need of 4,000 new workers on the back of a $1.7 billion expansion program that's happening there at the Super Pit. beyond the super pit, there's about another 40 mines, mainly gold, a little bit of lithium and nickel, but mainly gold mines in and around Kalgoorlie, Leonora, through that sort of southern part of southern central part of WA. And those mines are absolutely thriving at the moment. They're taking a lot of investment, domestic and international investment, to try and lift gold production. And what that's doing, it's putting outside of Leonora, it's a tiny little town with very little housing. It's putting enormous pressure on the housing market in Kalgoorlie, to the point where the government's actually stepping in now to really incentivise some new development. And I'll come back to that in a minute. But this particular development, which you can see on the right, where that blue kind of bubble is almost exactly where it is. It sits kind of between the town centre and the airport. It's in a really strategic location within Kalgoorlie. While Kalgoorlie has an enormous amount of land around it as a township, it doesn't have that much land that can actually be developed. It's in areas. This is probably one of the last pockets left within the township as it stands at the moment that can be relatively easily developed. So there's a developer that stepped in there that we're working with. They've got 200 lots of land, or just over 200 lots of land, that will ultimately get delivered, and there's homes being built on that, 2 and 3 bedroom homes. So it's in a really good area. And what's being delivered there is a development. It's effectively a gated community. There's security within the development. There's some green space. There's a club, some amenity within that club for residents. But it's going to be a beautiful estate, and probably the housing quality is going to be as good. Well, sorry, as good as Kalgoorlie's ever seen, but certainly the best housing in Kalgoorlie for some time. So there's 2 and 3 bedroom homes there. There's a couple of dual occs as well. There's 4 dual occupancies, which is a 2-bedder and a 1-bedder side by side. The 2 beds start at 565, and the 3 beds at it's actually the 2 beds are at the top of that, it's 575. The 3 beds are at 665, and the few dual locks are 850. So at that price point, people that have got, that's kind of absolute bare bone entry level investment at 575 on the 2-bedders. They're single part contracts, right? So it's 10% down, 90% on completion. They're going to yield the rental yield on these at 7%. And there's a fair bit of upside to that. So the minimum rent that the government is guaranteeing under a 10-year guarantee. So specifically the Government Regional Office of Housing, which is, or GROW, and it's often used or termed, is providing this 10-year guarantee at the moment. Now, there's not a lot left. We've sold, I think it's around 25, 30 now with a 10-year guarantee. There are a small number left with a 10-year guarantee. That guarantee is probably going to wind back to 5 years as we get into the next tranche. But at the moment, there is a 10-year rental guarantee available, which is giving you on the 2-bedders an absolute minimum of $750 a week, and on the 3-bedders $900, and on the dual occs $1,100 a week. Now, when you talk to the letting agent there at the moment, the 2-bedders are getting more like $800. The 3-bedders, rather than getting $900, are getting more like $950 to $1,000 a week, and the dual occs are getting about $1,300 a week. So the yield on this is absolute bare minimum 7%, but more likely running at 8%, and up to sort of 8.5, even 9 on the dual occs. So this is a really high yield, high rental yield investment. The question we keep getting from clients at the moment is it going to give me any capital growth? And we think it absolutely will, because when you just look at the basic fundamentals on Kalgoorlie, it has incredibly tight housing supply. And all the jobs, the demand on jobs, the biggest bottleneck at the moment for those jobs being filled is housing. It simply comes down to housing. So the mining companies and the state government with essential workers, they can't relocate people there until they can offer them housing. And there's only so many dongers that the mining companies can put people up in. That's fine for FIFO workers, but the permanent workers they need, they cannot get housing for. So that's why the state government stepped in. And with that dynamic of really tight supply and good population growth on the back of these jobs that have been created, people don't move to Kalgoorlie because of the beach, of course, or the lifestyle. they're there for work. It's a very strong economy, but it's all about mining, and we think that it will see really good capital growth. Kalgoorlie has seen good capital growth now for the last 3-4 years. Prior to that, it was bouncing around a little bit on very thinly traded kind of volumes. But when you look at the last 3 or 4 years, really steady growth, 5 to 10%, and we see that continuing for some time. So there's a couple of renders you can kind of see here. That gives you probably a little bit of a feel for this development. You know, it'll be really well landscaped, and there's parks, play equipment, etc. Around the club. So we love this development in Kalgoorlie. It's an undersupplied location. There is not many, in fact, in my time in property, in the last 15 years at least, I have not seen a 10-year rental guarantee available at 7%. I have not seen it. So this is extremely rare, and it completely de-risks it for someone. I think someone that's got a self-managed super fund, looking for something that's got good positive cash flow, good return prospects, at very low risk, this would be an amazing investment for them, particularly if they've got a relatively small amount of capital in the self-managed super fund or super fund looking to roll over. The quality of housing, as I touched on before, this will literally be the best housing in Kalgoorlie for some period, because the rest of it is a bit mediocre when you sort of go through the township, and quite a lot of it very old. I mean, Kalgoorlie was first established in the 1890s, so it's been around for over 120 years as a township, and a lot of that housing it dates back. Not necessarily 120 years, but it does date back a long time. And the track record of this developer is very good. I won't go through that in detail now. As I said, it's got a thriving economy when you talk about Kalgoorlie as a township. The last one that I'm going to touch on, and I'll keep it pretty brief, so I've got a little bit of time for some Q&A. The last one is actually circling back to the other side of the country in Brisbane, and specifically in the suburb of East Brisbane or Woolloongabba. So anyone that knows East Brisbane or Woolloongabba will know that it's on the southeast side of Brisbane CBD. We're talking 5-10 minutes to Brisbane CBD. This particular site is incredibly good location in terms of its proximity to not just the CBD, but also the Cross River Rail, Brisbane Airport, the University of Queensland, and a number of other universities. So it's really well positioned. It's virtually next door to the Gabba, which in itself is a great attraction. But come the Olympic Games and post-Olympic Games, that is going to be, that whole precinct is being transformed, and it's going to be an amazing part of Brisbane. This particular development is going to be completed as an apartment development. It's going to be completed at the end of 2027. It's currently under construction, and it's well underway. There's 210 apartments in total. There's 1, 2, and 3 bedders. There's actually some 4 bedders in there. The 1 bedders start at $795. They're well sized, good size. Obviously, this is a single part contract. We think it'll get at least 5% yield, and the capital growth in a place like this, it's going to be probably one of the prime beneficiaries of the Olympic Games and all the infrastructure going in there. We'll see at least 8% growth on average over the next 5 to 10 years. This particular development has got a 4% rental guarantee on it, despite us saying it's going to get at least 5. But there is that fallback of a guarantee there. And if you've got any international clients, there is currently an incentive where they'll rebate 50% of the FIRB fee. So beautiful development, probably hard to get a really good feel from this sort of selection of renders here, but it's going to be a really high-end development, probably one of the most luxurious apartments in all of Brisbane as it stands today, and you can see some of the amenity in there. That's just a little bit about this project. The supply and demand fundamentals in that inner Brisbane are about as strong as anywhere in the whole country, and particularly for apartments. When you have a look at the data around East Brisbane, Woolloongabba, Kangaroo Point, that pocket of suburbs, the unit prices have grown at about double the rate for the last 2 to 3 years versus house prices. It's a very tightly held couple of suburbs in there. There's very few development sites that are left. in all of that little pocket of suburbs. And for people that are downsizing, it's absolutely prime location. For people that are young professionals working in the Brisbane CBD, it's a prime location. And even from an affordability perspective, it's still pretty good, particularly in those inner suburbs. There is this massive rental shortage. You see the vacancy rates in that East Brisbane area and Wollongabba running at about 0.6%, so about as low as you see anywhere. As I said before, the Olympic Games and the infrastructure going in there, this is going to be a direct beneficiary of it. It's where Brisbane Live is going. The Cross River Rail is within about 400 metres of that. So it's got some of the infrastructure all around it. And yeah, the whole area, we think, you can get into this market now, and between now and the Olympic Games, you'll pick up some really good growth, and not just growth in terms of capital values, but also rental values. The rents have been growing at astronomical rates, and the pressure on housing supply, particularly apartments in those few suburbs, is just so tight that they are likely to continue growing. So the yields people can achieve here, while they might start at about 5%, you hold that property for 4, 5, 6 years or more, they could comfortably get up to sort of 8, 9% yield. So yeah, hopefully that gives you a bit of a feel for, say, those those top 4 or 5 investment opportunities we're running at the moment. If any of your clients are interested in those ones specifically, or others of a similar nature, obviously reach out to Rob and we can take you through them in a bit more detail. All right, I might pause it there. I think I'm going to hand back to you, Rob, if that's all right.
Thanks very much, Dan. That was really good, and hopefully everybody that's joined us has got some really good information there. I just wanted to touch on a couple of case studies we've got here. We've chosen a couple of different property types. We've included a house and land package. So just to be clear on everybody that's joined us, we do also do house and land. It's house and land is a bit of a quick moving market. So the way I like to work with house and land is, if you've got clients that are interested in a particular area, let me know, and I will I'll come back to you with some options in that area. So just quickly, we've got the first property here is one that's in Indooroopilly in Queensland, and our client purchased in 2021 for a price of $780,000. It was sold in 2024 and valued at just over 1.25 million, or 1.2 million, I should say. So that's a 54% return in less than 3 years with just a 10% deposit. So there's quite an impressive result there for the client. If we just switch to a house and land opportunity, Dan mentioned before that regional Victoria, or regional markets, particularly in Victoria and also Queensland, performing really strongly. Now, this one was done back in 2019 in Benalla. Purchase price back then. Oh, I've lost my screen. Sorry, guys. We'll just wait until we get the screen back. So I'll read off my notes here, but this property was in Benalla, purchased at, I'm just trying to read my notes here, just over 400,000, valued at, in 2024 for over 600,000. We're looking at a 40% growth there, attracting 7% return. So a good, strong outcome there. Obviously, with house and land, as at all these opportunities, it is a long-term investment strategy. And then the last opportunity we've got is Mermaid Beach, which was an apartment there along the Golden Stretch there, the Golden Mile, purchased in 2022 for 1.795. So this is for your sort of higher end, high net worth type investor. Valued in February this year at a whopping $2.85 million. So we've seen 59% growth there in just under 3 years, which is quite astounding. So there's 3 examples. We've got plenty of other examples as well. So what's coming up, guys? just to give you a bit of a taste and flavour for what we've got planned. The first one may not be necessarily relevant to some of our domestic partners, but we're going to Singapore later this week to do a live expo, property expo in Singapore, which will be running on the 16th and 17th of August. Then in September, where we've got a live project launch, so keep your eyes and ears out for emails. Details will be announced about that. Then we've got some monthly investment webinars planned for September and October, which will be once again via Zoom. Details will soon be released on those. And then we'll be continuing these quarterly updates where we review the quarter in the previous quarter and look forward to some investment properties. So the next one will be in November. Once again, stay tuned for more information. All right. We've run for about 50 minutes there, so we're just about to wind up here. I think if you've got any questions, please get in touch with me directly. My details are on the screen there. I'm going to be following up with each one of you individually after this anyway, but in the interim, please reach out for any questions with regards to the stats or insights that Dan's presented or any of the property investment opportunities. But I will proactively also be in touch. So thank you all for joining us. I hope you found it useful, and stay tuned for the next event. Thanks very much.